Hi everyone. Warren Buffett once said, "The stock market is a device that can transfer money from the impatient to the patient." This is especially true in today's world because many people often dive into investing without understanding the basics behind the stock market. Tiny mistakes can lead to huge losses of money, which is why it is important for people to learn before they experiment. Hi, my name is Yuktha. This is Stocks for Teens, and today we are going to be skimming through the basics you need to know about the stock market before you invest your time and money. Now, you might be wondering why a teenager is making a video about the stock market, but as a beginner myself, I think it's important to grasp the fundamentals before we start on our investment journey. Also, I realize that many people have the passion to invest, but just don't know where or how to start. So without further ado, let's get into it. So before we look at the stock market itself, it's important to understand the basic building blocks that make up the stock market, which can be represented by a stock. So what is a stock? A stock basically represents the ownership you have in a company or a corporation, and it is often confused with a share. People often use them interchangeably, but they do not represent the same idea. So let's take a look at it this way. Let's just say that your family decides to buy a cake for a celebration. The cake as a whole represents a stock of that company. And if you decide to take a slice of that cake or a portion of that cake, that represents the share of a stock of that company. So just as a recap, a stock represents the ownership you have in a company, while a share represents an individual denomination of that stock. So if you decide to invest in a stock, you can now claim ownership to a company's assets. And for this, you need a stock certificate, which basically provides verification that you do own that stock. This includes what type of stock you own and how many shares you have of that stock. Also, when you buy a stock, you automatically become a stockholder of that company, also known as a shareholder. And this is when the ripple effect starts to take place because the condition of the company that you decide to invest in has a profound impact on how well your stock will do in the stock market. For example, if your company is doing rather well, then you're more likely to make profits in the stock market with that stock. However, the converse is also true. For example, if the company you decide to invest in is in poor condition, then you're more likely to face huge losses. Finally, owning stock actually gives you access to more rights. What I mean by this is ownership to a stock allows you to make decisions in the company that might influence them later, such as determining stock price and much more. We'll be exploring stock price in a different video. So if you own more shares of a stock, then you're more likely to have more decision-making power in that company. All right, on to the next idea. I know I've mentioned this a couple of times in the last few minutes, and it should be pretty obvious, but it's important to say that stocks are put out by companies while people invest in stocks. The easy part to understand about this is people invest in stocks to make profit. Now, why companies decide to publicize these stocks in the first place is the bigger question. Typically, companies want to make and maximize money for financial success. And one way to do this is through stocks. There are many different reasons why companies do this, and some of them include financing for capital expansion, paying off debt, and financing product development. I mean, how else can Apple put out their latest designs of new iPhones and MacBooks? Leading on to my next point, IPO, or an initial public offering, is the first time a company puts out a stock on the stock market. The most prominent IPOs are found on the Wall Street Journal, such as Peet's Coffee and the Warner Brothers Incorporation. IPOs are typically not available to the public, and this is because initial investors who make these deals and buy the IPO in the first place often negotiate with the broker who writes these deals, and after they buy these stocks, not much are available to the public. Also, IPOs are known to be reserved for the elite. If companies like Google and Microsoft were to put out IPOs, which they've already done, then big buyers have more access because Google and Microsoft are prominent companies. Also, IPOs of other companies are put out for these big buyers too because they are more likely to pay more than the average individual. This is probably going to be one of the most important parts of the video, apart from learning tips on how to be successful while trading. But now we're going to be shifting gears and talking about how to recognize stock value. People don't just randomly pick stocks from the stock market and expect that they're going to make profits. There has to be a plan, and comparing shares of companies according to price and quality is a great way to start. In the stock market, you're going to be presented with many different stock options, and some of these stocks might share the same stock price. In this case, you would want to compare the quality of these two stocks. If two companies have the same stock price for a stock, and one has a generally better quality than the other, then you would want to pick the one that has better quality, because the bad quality stock is overpriced. However, this might not always be the option because you might be presented with stocks that share the same quality but not the same price. In this case, you would want to pick the one that's less expensive. What I'm basically trying to say is that you should try to minimize the amount of money you spend while also ensuring that you're picking the best option. I can't emphasize this enough, and this is really important, but recognizing stock value will heavily determine whether or not you will make profits in the stock market. You can also determine the value of a company, thus the value of a stock, in other ways. The first being through market cap. Look at the company's market value, which is also known as market capitalization. A company's market cap is found when you multiply all the outstanding shares of a stock by the price of a single share. Now, when I say outstanding, I don't mean awesome or terrific, although the stock market is interesting in itself. Outstanding shares are all the shares of a corporation that have been authenticated to use and have been purchased by investors. Now, there are different types of market caps that you can use while verifying how long a company has lasted. For example, when a company lies under a microcap, which is just under the benchmark of $250 million, then that company is typically known to be as a startup or a company that has just entered the realms of the stock market. Now, the bigger the cap size gets, the more powerful or long-lasting the company has been. This is why companies like Amazon and Facebook lie under the ultra cap, because their market value lies well above $25 billion. Now, here's a tip for stock investing. Stocks that lie under the microcap have great potential for change, but are really risky to invest in because you can make profits and losses in just an instant. So if you're a person who likes to take risks or likes to make profits in a short amount of time, then go ahead, invest in a microcap. This also applies for ultra caps, but they're usually more accessible to big investors. Now, companies that have stocks that lie under the mid cap are stocks that are safe, because even if you lose money, you won't lose that much. However, you typically won't gain as much either. So if you're a beginner, then invest in a mid cap because that's the safest option. This also applies for small caps and large caps, but they have different risk levels of their own. The final and most important thing we're going to be covering in today's video is how to be successful and feel confident while stock investing. Of course, it takes years of practice to master the art of stock investing, but here are some tips to help ease your way into making your first investment. First of all, analyze the company of the stock you're choosing from. Investors who analyze the company before making their investments often have a better judgment and understanding of the stock itself and what type of profits they're going to be making while buying and selling them. Remember, your biggest assets are your intuition and common sense. So if you feel like something's up or something's wrong, then trust your guts. Also, remember to analyze yourself. What are your investment goals? Are you planning to use the money you make immediately, or are you planning to save it for retirement purposes? Knowing this will help you know your preferences for what type of stocks you want to invest in the future. Second, know where to get your information from, because quality information is key to making better judgments and better investments overall. Third, why do you want to invest? I know this comes under investment goals, but think about it as appreciation and income through dividends. If you don't know what those are, then be sure to check out later videos. Finally, research and understand the world around you, because the environment that is created by economic, socio-political, and political issues definitely affect the outcome of your stocks that you will choose in the future. Guys, thank you so much for watching this video. If you liked the content, then hit that like button and please subscribe to my channel, Stocks for Teens. If you know other people who are potentially interested in learning about the stock market, then share this video with them too. Now, just a spoiler, in our next video, we're going to be looking at the stock market through a more technical perspective, like learning about what mutual funds are and what the bull market is, and so much more. So if you'd like to learn about that, then I'll see you next time.